Nothing in this program should be considered investment advice. It is for educational purposes only. Please hit pause and read this disclaimer in full.
It's getting harder and harder and harder to get your assets outside of our U.S. currency or outside the country. Like it's just getting harder because the Patriot Act, several other things, they're closing those doors.
Hello, everyone, and welcome to this episode of Finance University. I'm your host, Chris Martinson, and hey, we're back with Paul Kiker of Kiker Wealth Management. Paul, good to see you today.
Good to see you today. Great to get a chance to fellowship again.
Well, absolutely, and so much to talk about. I've got this completely full sort of set of bookmarks and things to sort of review with you, but first, I was a little underwhelmed with the debate last night because, you know what, there's big policies I really care about. So you and I have discussed this in the past, that last year or earlier this year, the U.S. Treasury Department came out with this really important thing, an annual report. And they said, United States is insolvent, right? Huge liabilities, insufficient assets. But more importantly, they said, and I'm quoting here, current policy is unsustainable, which is about as strong as a bureaucratic, enterprise could ever get in their language. But let's decode that. Current policy, that means laws that have been put in place, everything we think we're going to spend for the this act, the that act, the whatever. Current policy is unsustainable. And by unsustainable, they mean, wow, this thing's going to break someday, right? Yeah. And so obviously, in a debate, the debate moderators who were totally biased by ABC, it was terrifyingly biased. But nobody asked the question. There was not a single question about that idea that we have 35 trillion in debt. We're headed in the wrong direction. And the question I would have asked is, listen, it's clear that we're on this unsustainable course. The Treasury Department itself says so. What are you going to do about it? And if you're not going to do anything about it, explain why you think it should fall on the next administration to have to do something about it, because somebody's going to have to do something about it. So why isn't it you? And I want both of them to have to answer that question because I care. I don't want to leave behind a financially, monetarily ruined country. But that's where we're at. They talked about cats, J6 stuff, but not stuff I cared about. I care about inflation, monetary policy, spending, reckless spending, debt.
Yes. Yeah. Well, that's going to make people start thinking. I was so disappointed, and poor Holly had to tolerate me hitting the pause button and saying this should have been answered this way. There should have been more preparation there, and they should have called it out. It was embarrassingly biased on the moderators, and it was just like an entire try to gotcha moment. And I was really disappointed that Trump didn't address several things from healthcare to others that he could have knocked it out of the ballpark if he'd have been prepared for that. So I get it that it's a hostile environment, but you're right. Going to the base foundation, they didn't even ask the questions that should be asked. I mean, those are very important issues, and the current trajectory, even if Trump was prepared for that, he could have brought that up and said, look, what are you going to do different? Why haven't you changed this trajectory while you're in position of power now? So I was ridiculously disappointed.
Yeah, agreed. That's a great summary. I mean, here's something that I thought would have been a slam dunk, easy to care about, is the fact that auto insurance prices are up 54% under Harris and Biden. 54%. I would have been happy if they were up 0% because I'm a 0% kind of guy. I don't understand why these things have to go up at all. But 54%? Are you crazy? That's insane. And it would have been illuminating to find out if either or both candidate understood what the dynamics were and how you would address that, right? Because there's underlying reasons. So do they understand economics at all? Do they understand how this works at all? Right? But nothing, just chirping crickets. But everybody cares about that, right?
They do. They do. Well, and I was debating it with Holly after it was over because it took me a little while to go to sleep. I was just so frustrated and disappointed. What I'd really like to see is just put them in a room, give them some topics, and let them hammer it out. If it's 2 hours that they talk, I don't want moderators in there trying to debate and fact check. Do all that after it's over. Let them sit there and talk it out. Because a couple of things that we would need to see in the long form is get the moderators out of the way and let's see how they can negotiate with each other to get along. Because in that position, you're going to have to be able to to put down your animosity toward the other party or other individual or your feelings to work towards what's best for the nation. And I would love to be able to see them do that. And then the American people can really see what's going on. But, the problem is the media wants to be. I wish I could think of how Jordan Peterson explained it here recently, just talking about one of the most sinful things that we could do is fall into the pride of our intellect. It's like they feel like they need to control because the average American is just not smart enough to really understand. That's how they see the average American, and they're missing the great diversity, the great strengths and benefits of every single American brings to the stage, and they have to control it for whatever reason. And it's wrong, it's sinful, and it's embarrassingly foolish, quite frankly.
Well, I have, speaking of all the people unprepared last night, the moderators, wildly unprepared, didn't have the right questions, but their fact checks just got fact checked and they were wrong about a lot of them. Like, how do you get these things wrong? But they did. They got them wrong over and over again. So it really speaks. It's almost demoralizing, Paul, because what we're talking about now is like a level of competence. It's like we can't protect a presidential designee in a simple environment. We can't fact check simple things. Like we don't share simple landscape anymore. And so this is why I'm a little worried about this, particularly from a financial standpoint, monetary, economic standpoint, is we're facing down some really, really big challenges, right?
Yes.
And unfortunately, what Kamala is promoting, and I still don't know what Trump's promoting because he says he's going to be different, but last night would have been a great time to explain exactly how. Yep. Didn't happen, but maybe it's coming. But Kamala at least has said, oh, we're going to solve people not affording houses by giving everybody 25 grand to buy a house. Like, oh, boy. Doesn't understand the basics, right? Houses go up by 25 grand. That's all that happens.
Exactly right.
That's like, it's very easy to sort of explain that, but they don't, like, somehow we have a level of incompetence where you have to fight past that one idea, which means there's just, what is it? It's the dumbing down of America. We're just so dumb that the journalists think they have to protect us from bad information when they don't even know what the information is and don't even know the right questions to ask. And we have these failed economic policies that, here, you want failure? Here you go. Here's government failure. The average U.S. family health insurance premium in 1999 was $6K, and now it's $24K.
Yep.
That's failure. That's government failing. Hello, government people. Can you explain why your government's going to fail less than government has failed to this point so far? Right? Mm-hmm. That's what we all deserve to ask and be answered.
Yeah, and I'm trying to pull up the healthcare ETF right now. I mean, healthcare has been one of the better performing sectors of the market since 2010 because of the profitability. It's come out of the pockets of the American people and into the corporations is what it's done.
Yep.
And our service is far inferior to what it was before.
So right here, health insurers, this is just CEO, not the whole C-suite. We're not talking CFO, CIO, C everything O, right? COO. $27 million for Cigna, right? United Healthcare, $66 million. Do you know how many $24,000 family health premiums are required to pay the CEO of United Healthcare $66 million? For one dude, for 1 year. And it's been like this over and over. His first year coming out of Obamacare, the ACA was $150 million, right? Unbelievable what they've been up to. Average pay raise, 473% pay raise on the backs of working Americans. So then I think you can ask a very simple question, which is, how are you going to control rising healthcare costs? Like, oh, that's easy. I'm going to slam. You know what? I'll find somebody to run United Healthcare for $600,000. Bet you I could. I bet you I could.
Do they really need to be publicly traded, right? I mean, that's one thing that I have an issue with. If you're in a situation where you're taking in money to send out to the participants inside of there, look, I know you can get the capital markets for funding, but does it really need to be publicly funded? Because now all of a sudden the shareholders are going to be trying to maximize profitability. So $66 million at the average premium of $24,000 a year means it takes 2,750 people paying their premium each year just to cover his salary.
One guy in the C-suite. Wait till you see the rest of the C-suite packages.
Well, and here, like, look at this. I got to show this because this is one thing I like to point out from time to time. This is the XLV, which is the healthcare index, and it goes back to 1999. So notice from 1999 to 2012, it's relatively flat. So Obamacare comes in
As it should be. It's
It
just
should be.
healthcare. It's a service industry. You
Yes.
compete it away.
And then poof, you've had this just magnificent return over that period of time, which has been great for the shareholders. But the question is, has it been better for the participants? Right? No, we've got to get the corporate capture out of the healthcare industry, the military industrial complex. And that was a missed opportunity where, we heard RFK speak. He was very clear in being able to communicate that out there at Dallas, just the corporate capture. That's one area that I was disappointed in Trump not being able to articulate any of those points, really.
It was, I saw a lot of those clips went from that RFK piece that we were in the audience for out there in Dallas. A lot of those clips went all over the place, including the stuff about the healthcare and the fact that, pediatricians are often now a captive thing and it's a weird dynamic with healthcare, gives them these huge bonuses for making sure that everybody's vaccinated in their clinics practice, right? Which is way beyond the return you would get from the cost of the vaccine. It's something, there's a different economic driver operating there, which RFK pointed out beautifully. But speaking of which, how about this one, right? So this is total return since 1989, looking at aerospace on top, which is defense. S&P 500 is a total index, and then industrials have returned a not terrible 8% a year. The S&P's been up 10% a year on average since 1989, but aerospace defense has been up 12% a year. Look at the compounding effect, and look where it really takes off. Isn't this, I think we had a Nobel Peace Prize winning president take office right about there when
Right.
I'm so tired of our blood and treasure, Paul, going to wars. It's like it's just like somehow we just skip from one war to the next, right? It's Iraq. Oh no, it's Libya. I'm sorry, it's Syria. Hold on, it's Ukraine. When that's over, it'll probably be Lebanon or Iran. I'm tired of this. And by the way, I have worse internet at my house than they have in basically a village in the Philippines right now.
Right.
Just how it is.
Because we've been putting it into things that'll blow up for corporate profits and at the expense of our infrastructure. And our infrastructure is going to become a major issue because the longer you put off maintenance and repair and upgrades, the more costly it's going to be in the future. It really is.
And this is what I wanted to see come out last night, not to make this political, but I wanted somebody to go, listen, if you can vote for more of that or vote to put more of those, take those funds and actually put them back into America again, and that's the decision, then I think people should decide what they want to do about that. And I'm pretty clear where the country would fall if it was presented properly.
Right.
Which is
right.
that's the, do you want more of this big giant government that does whatever it wants without anybody voting for it? Like, simple question. Like I do not understand. Like if I was up there debating Kamala Harris, I would have said, can you explain to me who's actually running the White House right now?
Right. Yeah. And just be quiet.
just, like, hey, you apparently interact with Biden more frequently than anybody, and you didn't notice that he was unable and unfit for duty until his debate. Somehow that escaped your notice. What kind of president would be that unobservant? I mean, there were just so many attack vectors there, but it's been bizarre. But to me, if we got to talk about this, right? And where that's all going. So I'm just worried that nobody's going to talk about it. We're just going to keep spending as if there are no limits. And then we're going to get back to that Treasury report, which clearly says, Houston, we have a problem in here, which fundamentally, I mean, you remember, so let me just pull this chart up so we can be on the same page about this. Because this is one I'm just like, oh no, oh no. And I'm thinking about kids and grandkids. I don't have any grandkids, but if I did, it's this. That according to the Treasury Department, the debt held by the public, which by the way isn't the whole shooting match, because there's this other debt they say is not the same, which is intragovernmental debt, which is a really dumb idea, right, Paul? That's you wrote yourself a check and you put it in your other pocket, and it's somehow an asset. It's a weird thing. But they go here from we're here at they're calling us at about 120%. With intragovernmental debt, but they're saying we're at 100%, but it's going to go to 550% debt to GDP. And my position is like, no, it's not. It's not going to.
No.
It's going to break somewhere in here before the 200% mark. So somewhere between here and 2040, for sure it breaks. I think it breaks earlier. That's what we need to talk about is like, well, when it does break, then what happens?
Mm-hmm.
And that's easy. That's inflation. It's hyperinflation because they'll have to print.
And that's when misery is going to come and visit in far greater amounts than what the American people are suffering right now from the inflation that we're under. I mean, it's ridiculous. And that we're heading in that direction, like you said, they don't seem to be concerned about it. I don't know if they're just so detached from reality that, they can pick up the phone and ask for money and it just shows up. Or the fact that you're in politics and you've got so many people trying to get in your pocket or get into their strings on you so they can maneuver you to your own benefit, that they've just got money being thrown at them left and right. I don't know how they're so detached from reality, but they really are. I mean, we would be better off to take the average individual, middle American individual, and throw them in that position that knows how to balance a checkbook than what we've got in the halls of power right now.
I know. So given that, this is why, for everybody listening, this is exactly why peak financial investing has been stood up, and exactly why Kuiper Wealth Management exists, is because running a risk managed portfolio, being very careful, seeing these dynamics coming early and often is actually really important. And there are ways to help protect, and maybe even if you run things right, there might even be ways to benefit from all of this if you can see it coming in advance, but you got to see it coming. So you need the context, and then you have to run a portfolio. Not like this is a whole new future. Paul, when this really breaks, everybody who's running what I would call a standard approach is going to get the same standard reaming out of the situation, because by definition, everybody can't be protected from a mass casualty.
No.
Because that's what we're looking at here. So I look at this chart and listen, it could end in a deflationary plunk, but it won't. At least as far as I'm concerned, it's probably more likely going to end up in a large inflation. The Fed will print. They'll print, right? As Maya Angelou said, when somebody shows you who they are, believe them the first time. The Fed's shown over and over again. They print. Okay. So if we believe they're going to print, how do you help people sort of navigate that likelihood?
So that's a great question. More importantly, the structure of how we built our portfolios to be able to adapt. The fortunate and unfortunate thing is me being kind of seeing the seeds that were planted of this back in 2004, 5, 6, and then by God's grace successfully navigate in 2008. My concern back then was like, when you look in the long-term trajectory, and nothing has changed, right? Now, it was so concerning. It's like you think it's going to happen in the next 2 to 3 years, and it's lasted a lot longer than what we expected. But building portfolios that can adapt and learning from history. What did German citizens do to be able to, those who were successful, right? Because nobody really knew what to do. But you go back and study history to find those threads of success for those individuals who got assets outside the country. One thing that concerns me about where we are right now is it's getting harder and harder and harder to get your assets outside of our U.S. currency or outside the country. Like it's just getting harder because of the Patriot Act and several other things. They're closing those doors. Then you look at precious metals and a shift in the investing from the things that we want to own to the things that we have to sustain. So there are strategies that you can utilize and implement. One of the hard parts is knowing exactly when to implement them. And I think the problem with investors they have is they're expecting perfection, right? Nothing in life comes through in perfection. Some of the most successful individuals are going to have failures, but they adapt quickly and they get up and they stay disciplined and they move forward. So what we've built our strategy to do is build discipline in there that tells us, okay, now like a dimmer switch, it's time to start allocating to this category. Now it's time to get a little bit more aggressive in this category. Now we have the tools that tells us to be more aggressive within that category. So whether it's international assets, commodities, and that's the thing that I'm very concerned about what's taking place with your standard. In reality, I hate to say it, modern portfolio theory is just kind of the cookie cutter approach. Like the more I've thought about it and the more I look and the more people I meet and just the different presentations that are out there, everybody's doing the same thing. Everybody's on the same side of the boat. And people, I think, don't understand what is taking place, and they've been marketed to from the passive investing standpoint that everybody is passive in one way whatsoever. So yeah, they're going to manage risk by diversification, but we see in 2022 when the market dropped, bonds went down 20 and stocks went down 20. There was no risk reduction from that diversification. So by having a strategy that says, I don't know exactly what tools are going to perform the best, but I know what categories are going to be, at least have been historically, and we're going to continue to search for all of those investments out there. And it's a mindset that's important to survive an inflationary holocaust. Chris, I'll tell you quite frankly, I wish it was as simple as a deflationary bust. Like really all you have to do is be prudent, and you can be conservative and be protected in that manner. But here's the thing we know about the powers that be. They hate the prudent and they hate the conservative, right? I mean, that's as clear as I can state it, because they want us to be foolish. They want everybody to be in debt. They want everybody to be pushing. They've got that mentality that's like, hey, hire an employee that's in debt because you know they're going to show up to work. It's like they know that they can control us a little bit more, and now all of a sudden they're our masters, right? Our fate is at them. So I wish it was a deflationary bust, because that would be easy to navigate through. But an inflationary holocaust is something to where, unless you have tools, unless you have a willingness and a mindset to look at the investments in your toolbox and say, that's a tool that I may not have used for the past 10 years, but I have guidance, I have direction, I have a repeatable process that'll tell me when I need to own that, and I can confidently plug it into the portfolio. And hey, if you hesitate in that first step, you're still going to be 10 to 12 steps ahead of the average person who's going, at first they're going, hey, what's going on? Like, you know, their straw house is blowing out from around them, and they're frozen because they don't know any other way, because they've not run across. There's just very few people out there that have had the fortitude and courage and discipline and understood really, and actually the thick enough skin to continue to stay down this journey. There are a few people out there, but they're far and few between. So that's a really long-winded answer, and I apologize. I know I tried to grab everything, but you have to be open-minded, you have to be willing to take steps, and you have to have a process in place that will direct your assets. Because it may be for a period of time initially when the inflation takes off that the market goes down. That's counterintuitive. And so you're protected, and then you redeploy capital in certain areas, and then you may have to shift from one place to another as that inflation unfolds. But there's no easy way to navigate it, and there's no conservative way to navigate it.
Yeah, well said. So here's my. We've talked about this before. So I think I have a pretty good sense of what the Federal Reserve is going to do if they get their druthers, right? I know how they would like to behave, and they've been able to behave however they wanted to behave, and the whole rest of the world's just sort of had to put up with our malarkey, right? Mm-hmm. Third world countries and undeveloped countries having to eat inflation that we've exported and all that. But I'm a little worried that the game has changed. You and I have talked about it. On February 28th, 2022, the United States government weaponized the dollar, seized Russia's assets, even seized oligarchs. We call theirs oligarchs. Ours are billionaires. Our Bill Gates, he's a billionaire. That guy's an oligarch. Difference is nationality. So same term. Seized their yachts of people who didn't directly do anything. So he said private property doesn't matter. Your sovereign reserves don't matter. So they weaponized the dollar. I think this is going to go down in history as one of the most colossally stupid blunders. Again, perfect policy decision that I think would have, on a foreign policy. Hey, Harris, can you please explain why y'all chose to weaponize the dollar and how you see that playing out to our long-term advantage?
A great question.
That would have been a good one, right? But didn't happen. And because of that, we don't have an answer. But now you and I have talked about what the BRICS nations, that's Brazil, Russia, India, China, South Africa, and 120 others who've signed up for this now. So seems to be a coalition of the willing in the real sense. And they had something called the unit, which you introduced to us. Mm-hmm. And I just wanted to go to this real quick because I just came across this post the other day, sent it to you. I think you read it.
Yes.
This is from somebody called Make Gold Great, again, at Make Gold Great, which I'm a fan of. And it reads here, the largest Russian news agency has just confirmed the long-rumored The Unit, which we discussed, is real, with announcements to be made at BRICS on October 24th. Talk about a surprise announcement, if October surprise if it happens. Article suggests what we talked about back a couple months ago, that it would be 40% gold-backed, okay? And according to Andrew McGuire, this would require a minimum of $3,000 gold price just to have enough basic liquidity to function. Double popcorns on that. One of the biggest developments in our lives, Western media, total crickets, obviously. And so lots to follow up here and take a look at. And then there is as well from TASS News, which is coming out of Moscow, saying, sure enough, BRICS countries are developing a wide range of instruments for creating an inclusive international financial system. Some of them may be announced this autumn at the summit in Kazan. And so what are we talking about? Well, basic projects, the unit, which we talked about, a
Yes.
platform for international settlements called Bridge, and a system pay for a payment rails and a depository clear. So we have the unit. We got Bridge, we got Pay, we got Clear. Paul, kind of sounds to me like they've set up a parallel system and they're looking to completely cut the tether lines to the sinking Western ship. This is big news to me.
That's huge news. That is huge news. And it's something that goes all the way back to 2010 when President Medvedev, in the original conception, came out with the SDR, special drawing right gold coin. And it's evolved since then with the new technology. Well, the arrogance in the Western media is that they're not going to do this. Okay. But in that same article from TASS, it says the key principles in designing the new financial system are decentralization of international interaction and the use of digital technologies. And, in particular, Milcalation, and I'm sure I brutalized that, please forgive me, noted that BRICS Clear will, quote, use blockchain to record securities and exchange them. So it's an amazing system that they have put together that's decentralized. So now all of a sudden, Russia's not in control of it. China's not in control of it. But they've come together in an agreement together that says this is what we're going to put together as an alternative to the U.S. dollar. So what are we going to do, right? I mean, I believe more Americans are so frustrated from the powers that be preaching down to us that this is what we should do when we all understand that they're detached from reality. Why is the rest of the world not being that way when we've weaponized the dollar? You can't trust us to tell the truth anymore. Okay. You just can't. So if you can't trust us, that's the one beacon of light that we had throughout history, is there was the rule of law within the United States that you're going to go through a due process. Well, now the rule of law doesn't matter. There's no boundaries that they're walking through. They just do what they want to do, and the courts are not there to stand up for the average individual on the national side. They weaponization of the dollar. There's no boundary by integrity. So we've basically made the pain of changing, moving to this system, easier than the pain of staying the same. And my concern is, it doesn't really matter if the Fed starts printing money if there is a viable alternative to the U.S. dollar, and this clearly is, right? This is clearly a viable alternative. It checks all the boxes. Now you got 60%, 70% of the dollars in circulation around the world. I think it's 60% the number. This is just approximate because I can't remember exactly, but there's a large portion of dollars that are in circulation outside the United States that don't need to be held there anymore. All of a sudden, now U.S. citizens are competing with all of that money coming back to buy food, land, houses, cars. Our currency declines. We've got so many things that are produced overseas because that was the most profitable thing to do. And then that's literally a great reset for our country, and not in a good way. That's in a manner to where it's going to be an equal opportunity bringer of misery. And the reality is for those who have an investment strategy that can adapt, and those who have done the research to look, they're not going to come out unscathed. They're still going to have some scars and scabs and some scuffings, but they're not going to get run over by that inflationary train, because they'll be 3, 4, 5, 10, 20 steps down the path less traveled, because they recognize the signs of the times and realize that they don't need to go off the herd with the soundbite investing strategies that people are falling into because it's easy.
Well, this is a big deal because let's imagine. So, first, they'll have to put capital controls, because if all of a sudden there is this thing called the unit and it's 40% gold backed, and I can freely, let's imagine I'm a big international company, I get to decide where I'm going to keep my treasury reserves for my functions. And I either can pick dollars, or I can pick, pounds, I can pick euros, or I can pick this thing that's 40% guaranteed backed by gold. Now there's competition. Darn good chance I'm going to start, because that's not going to zero, right?
No.
It's not going to zero. I know that much, right? Whereas I don't have that confidence around other things. So anyway, point is, we have competition on the landscape now where people can actually make a decision or a choice. Your first prediction is you're going to see capital controls put on Western nations so that people like you and I wouldn't be able to access a unit currency system. That would be too much of a threat. But my point before was that the Federal Reserve is going to do what it's going to do unless it's forced. So you mentioned something very important. There's all these dollars that are offshore. They've just been out there, and we export a lot of them, and they're sitting there. And all of a sudden, let's imagine I'm one of these foreign countries. It's like, dollars or units? You know what? Let me mix it up. Half of each. Well, what happens to those half the dollars I used to be holding, right? Well, off they go. And then those start coming home. And the way we experience that here in the United States is falling currency and rising prices for things like oil, anything that's internationally traded. The only thing now, the Fed is actually in a box. It's going to have to raise interest rates in order to defend that dollar, right? You have to raise interest rates enough so that people go, well, do I want units? But, treasuries are yielding, pick a number, 12%. That's good. Think about those higher interest rates slamming into an economy that has $100 trillion of debt on top of it now, which is the total number, not federal number. People know it's 35 trillion. This is a problem. Can you imagine $12 trillion getting, going into just interest payments? That's half the economy. Anyway, it's the whole thing breaks very quickly. This is what I want to alert people to, is that I see the unit as a forcing function that potentially causes the Federal Reserve to be on the defensive, not offensive part of the monopoly board.
Oh, no doubt. And all of a sudden, all of these programs to where they're spending and fiscally irresponsible to try to prop the economy up are gone overnight. And the American people aren't ready for it when their savings rate is down dramatically. And that made me think. I was looking at, if I can find the chart here, I wanted to point out federal budget surplus or deficit. Let me shorten this up a little bit and I'll show it, because we're already in trouble. So you add that on top of it in the situation we're in. I mean, literally, what is it that you do if you're in a situation in a battle and you want to avoid war, right? You wait till your opponent is in a very weak position, and then you capitalize on that. We're in a position right now to where we put ourselves in that weak foundation where they could take advantage of us. So, and you go look at that deficit just here to bring it up. So you can see here, this is our deficit going back to going all the way back to 1902. We stay in there. We're fiscally responsible. We bounce a little bit, and then woof. We haven't seen anything yet. If if interest rates were to jump dramatically. I mean, there's what is going to change this at this point with the policies that we have in place? That's
And
a huge
by the
concern.
way, love the chart, but that's a cash accounting basis chart. The accrual basis accounting chart is actually 2 to 3x worse than that on a yearly basis.
I love the fact that you point that out, but 2 to 3 times worse. So it's
Well,
even
it
worse.
is.
Yeah.
It is. This just went out for people who haven't seen it. I put out a piece about this Treasury report, but it's in black and white. It's right here. So let's take a look at this very quickly. Okay. So this is from the U.S. Treasury's annual report for 2023, right? Get my little dotty tool out here. So it says here, well, the gross cost on an accrual basis for the government was 7.8 trillion, right? Net cost. And we took in 4.4 trillion. So we actually had a 3.4 trillion negative net operating cost, but they only reported a cash basis budget deficit of 1.695, call it 1.7 trillion. Where did the other 1.7 trillion go? Missing in action. It's just stored for the future, Paul. That's for your kids, your grandkids. That's for later, right? And of course, there it is in black and white. And this is the landscape that I'm worried about, because we're steaming into this full steam ahead. You know, there's icebergs in the water, full steam ahead, you know, and we're just pretending like we're untouchable, you know,
Yeah.
like nothing, we don't really have to worry about this, you know. We dictate the terms of reality. And you got all those BRICS nations over there very quietly preparing for a different reality. Wow, it's a big deal.
Well, and a bully can dictate the terms of reality until somebody punches them in the face. And that's my concern. We're acting like a spoiled rotten is a leadership in our country, spoiled rotten bully that's gotten everything they wanted. Their parents have bailed them out in every circumstance, and now they've become a monster, right? And but one thing I got to thinking about, this just popped in my mind, so I pulled it up. You know, it was April 1st of 2019 when the G20 changed the asset classification on gold to move it from a tier 3 asset to a tier 1 asset. Now, if I remember correctly, a tier 1 asset is just considered, along with treasuries and the core holdings in the bank, one of the safest things that they can have.
It's good. Yes, good as cash, treasuries, and gold. Those are your
Correct.
tier ones.
Cash, treasuries, and gold. But prior to April 1st, 2019, right, it was a tier 3 asset after it had been a tier 1 asset, what, in the 1990s? So what is it in 2019? Is it that those bankers knew the unit had moved far enough along in its progression that it became a potential that they get together and they're quietly change it to a tier 1 asset so they can start accumulating? Now, whether they've accumulated or not, I don't know. I'd have to go back and take a look at that. But we can clearly see that this unit is gaining momentum, and we've heard that they're going to announce it in the past. It's not happened, but the pressure keeps getting worse, you know. And I wasn't able to find it here at the last minute, but I know there's been some issues, or there's been some talk with what's taking place with extra sanctions that the U.S. is talking about putting on China so that they can restrict their ability to do business in rubles. So it may be to the point now that China's like, hey, we got to implement this thing, and it's announced in October. And that's a game changer. I don't know what it does for the dollar immediately, right? Because it's going to take some time for it to be adopted. But I would anticipate that that's good for gold. And maybe, you know, you go back and take a look at gold prices on those major breakouts. You know, that was a big deal when gold made that move earlier in the year. We just didn't know what was taking place because it's not U.S. investors that are chasing it. But maybe that's the one threshold that people said, hey, we're not going to keep trying to wait and buy at this resistance level. We want it now because of what outcome is about to arise.
Yeah, you know, gold has been just remarkably resilient. They keep spanking at it and doing their usual shenanigans. It's, you know, hanging tough above 2,500 an ounce. And it just speaks to, like, as you and I have talked about, Paul, there's a change in the air. I've been watching gold for decades. I hate to say it, but I have. My first gold purchase, and I remember I was like, this is so quaint. It was $300 an ounce, give or take like 50 cents, right? And I remember because I used to watch it even back then, and I didn't have these instant daily updates. Like, there was this website I could go to, and it would sort of update, I forget, twice a day or something. But if it went up or down 50 cents or a dollar in a day, that was big news, right?
It was.
And that was then, but that was at any rate, watching. So I've been watching it since $300 an ounce. I kid you not, daily when it's trading. I've seen it since then. So, okay. It started doing something different in 2022 I'd never seen before. I don't have a model for it. It's like operating in new ways, and I'm just observing and seeing, because I have to come up with a new understanding. I totally knew gold before. If you could show me negative real interest rates and invert it, I could tell you the price of gold, whether it was going up or down. If you showed me the movement in the dollar, the correlation was high enough, most of the explanatory function could come from that. One of those two things. Now it's just doing whatever the heck it wants to do, right? And so it's being driven by other factors, and I don't know what to correlate it with at this point. So just watching. But it's different, and I like it when things are different. It gives you some information.
I do too. Well, and I have to show these because I love these two charts because they do give us a lot of information just about the change. So this is gold on a monthly basis, and this is going back to 1995. And I've got, some
Love that chart. Yeah.
red and green are just kind of cell signals that were generated, but we're flirting along and it's bouncing and bouncing, and boom, it breaks out. And we've held that breakout. I mean, so far, we've not even come back and tested prior resistance, which typically happens. And that's just a testament to the strength of the move in gold, especially with interest rates being high. But this is one of my favorite charts that I like to look at from a long-term standpoint. So this is gold continuous contract going back to 1975 with a quarterly price to PMO or moving average that's over the bottom of it. And you can see that kind of was tells you to avoid it for a period of time. And then in the early 2000s, that moves on an offensive signal. You take off. But look at this huge breakout that's taking place quarterly. You've got just continued follow through on a quarterly basis. And we're nowhere near on the relative strength index overbought like we were back in 2011 and 2012. So, whatever is causing gold to move, I mean, that's a sheer vertical move, like a near panic purchase, which the same thing occurred back in 2019, and then it consolidated and started to take off. So, there are forces behind. And here's the interesting thing. Have you had a cabbie, an Uber, have you had one of your grandkids call you up and say that they, hey, mom, dad, you got to buy some gold, right? Nobody, there's no sentiment out there right now. So this is either sovereign institutions or professionals or foreign governments that are, have been quietly picking it up. I would assume this is speculation on my part because I haven't had any general retail call me or anybody have a conversation about gold. And I was having all kinds of conversations. I could have lined up in 2012 if I'd have just started telling people to buy gold kind of at that price when sentiment was high, and had people lined up down the street and appointments 6 months out, ready to buy it. And right now, you still kind of have to convince even the ones who know that they need to own it, that it's a good asset to own, because there's just not that much retail momentum. But when it comes, it's going to be fun.
There's another thing that used to track pretty well for me was grams of gold to buy a barrel of oil. And it was noisy, but okay, it makes sense, right? There's two physical things. They have a relationship, right? And they're both sort of correlated with the dollar, so there ought to be some. It was okay. It's a little noisy. Boy, that's broken. That one just got shattered and broke completely. And by the way, not for nothing, but looking at this, this is the price of oil over time here. And I hate these little pop-ups. So get rid of that. So it's up a buck today, just bouncing a tiny bit. But here we see it's come all the way down from 85 in July. It's down at 67. It's down here in this range around 70, below 70. So it's just been going nowhere. I don't understand this because we're at the lower end of the 5-year storage for OECD. We don't have a lot in storage right now. We don't have a lot of new drilling going on. Everybody's talking about where's supply going to come from over the next few years. This looks like, so Zero Hedge put it really well. Inflation's coming down. We just had an inflation reading today. They said, inflation CPI in the U.S. is at its lowest since 3 years. Again, that doesn't mean we have negative inflation. It just means it hasn't gone up as much as it has recently. I don't know why that's such a source of confusion for journalists, but second grade math seems to elude them in this stuff. But at any rate, Zero had said that we are one energy shock away from just repeating the 70s.
Yeah.
Right. So something happens in the Middle East, the Strait of Hormuz gets locked down, something. If we get one of those geopolitical supply shocks, or eventually people just wake up and go, wow, we should have invested over the past 5 years, but forgot to because it was all this negative sentiment. Paul, I really think we're going to be seeing an oil shock in the next year or two. I could be wrong, but I think we're going to see that. And then we're going to see part two of this inflationary hike. And then if that comes with this whole unit thing around the same time, a lot of things stacking up to say, wow, you better have a plan, and being paralyzed with fear, it's not a good plan.
No, it's not. That's one of the things we've been talking about on the investment committee recently and having conversations around. It's like, okay, what if we head down this path? I spend a lot of time scenario planning, and I spend a lot of time actually planting seeds with clients so that they kind of have an indication of what we're going to do. Because when it happens, right, we haven't had that happen in the past. I mean, we've had oil shocks, right, but not a currency collapse. We've been basically built from not being the global reserve currency to the global reserve currency. So in America, the sun has been rising through all of history, and it's panned out in our benefit. But because of, and here's the thing that concerns me. Now, I don't know that I would have the restraint that some of the other countries do with the way we've treated them when we're this weak. We've opened ourselves up to an oil shock, to a financial shock, to a, an economic shock. I mean, just imagine if somebody got together and said, we're just not going to ship oil, or we're going to shut down shipping in certain parts of the country, what that's going to do to us. So we have no armor. We've opened ourselves up to our enemies to easily cause us a lot of pain. So that concerns me greatly, and it doesn't make sense that oil is just so oversold like it is right now.
Well, speaking of mysteries, I know markets get a little bouncy near turns and tops and bottoms and all of that, but this one, I don't understand this. So the S&P is selling off here because CPI came in less than they thought, so it kind of reduces the rate cut. And then all of a sudden, magically, here at 10:50 in the morning, maybe 10:45, it just decides ruler straight to go the other way. This is over 160 points. Paul, what in the news cycle came about to suggest it's time for a 160-point ruler straight launch of the S&P, besides the fact that the Federal Reserve likes stocks to go up coming into elections? What else you got?
Well, hey, I can build the narrative from this standpoint. The Fed's getting ready to cut. And, so yeah, inflation was a little bit higher, but things are slowing. The Fed's getting ready to cut. So the market's off to the races. I mean, they have essentially trained Pavlov's dog, the market participant like Pavlov's dog, to buy this dip and, hey, asset prices are going to take off. So I think this is a psychological thing. And I think it's a computer algorithm thing where the same psychology has designed the trading programs to be able to move, hey, anything that's going to increase the likelihood of a Fed rate cut, they're not going to let this market sell off. You better buy the dip because, you're not going to keep up with the Joneses if you don't. So I think this is late market cycle, pure speculation for individuals that had convinced themselves this is the new way to invest. I mean, I think that people believe it's completely different this time, that the Fed's going to save the day. And they look over at Germany and say, hey, they've had a bad recession and their market's going on to all-time highs, so the U.S. is going to be okay. Yen carry trade started to blow up. I think that was a birth pain. Mm-hmm. I think that was a shot across the bow for the investor who's willing to walk the path less traveled. You've got to pay attention and look for your exits. But I think it's a psychological standpoint behind it, really, just from what I'm seeing out there. Maybe that's not dark enough, and I think it makes the powers that be really happy because, hey, if the markets are great into the election, that's one less thing they have to worry about stacking against the current administration as potentially not retaining power.
Yeah, well, we know the Fed is completely a political animal, completely biased, and it will do what it can to keep markets stabilized, which is going up and to the right. But the other way for me to interpret this is to say we're heading into like let's imagine you're really big money, Paul, big money, like trillions, like your Norway sovereign wealth fund or all the big money. They can't all move into gold. They can't move. Couldn't even begin to move into silver. It's just commodities, just tiny. So let's say the Fed's going to have to not just cut rates, but start going back into QE. Every possible dip is just another opportunity to go a little bit longer because inflation is coming, and it's really hard to protect $1 trillion from inflation. If that, like, let's say you're BlackRock, how much do they have now? 1.72. I forget what the number is. It's some ridiculous number. But if you're BlackRock, why isn't this just BlackRock saying it's the only game in town for dudes our size?
That's true.
Every time I see it bounce hard like that, I'm worried that somebody knows QE is coming and I don't, right? I'm like out here in the cheap seats looking through the window,
Well, they're going to know before we are. One thing that I like to take a look at, just to kind of reference in the big picture, because when the market starts really getting gyrating like this, I just want to pay attention to support and resistance levels in the markets. So what I'm showing here is basically the S&P 500 on a daily basis. The white line's your 200-day exponential moving average, your 20-day. But, we have this big bounce off of short-term support here, which is not uncommon. So we did kind of reverse around that area. At least there's a battle in place. But we've also stopped right here at the 20-day moving average. But we've got a declining trend, tops in place, lower highs. The question is, are we going to get lower lows? So, if we are topping in this market, this is going to be a battle in this area right here, and we're not going to break through the top side of that range. We may go lower. So bull markets aren't going to die easily because you've got market participants. Some people, if we get back close to this 200-day moving average, you're probably going to have some people get in there for a bounce. But in the big picture, it still, to me, looks like we're in a topping process, and this is just part of that psychology that's taking place. At least that's what I have. If the information changes, I'll change my mind, but that's what it looks like to me, is we're in a topping process.
Yeah, and as you and I have discussed, when do you get to the tops? Well, when the fat lady sings, as they say in the opera, but that's when the Fed sings, right? When the Fed finally starts cutting rates, that's pretty reliably sell the news kind of a moment.
Yes.
So the fact that the Fed is toying right now, the debate is, was it 25 or 50 basis points,
Mm-hmm.
It's still a cut. It's still a change in trend. It's still somebody singing,
Well, and that kind of brings to mind a conversation that I had over the weekend, which was very interesting. So, I'm a big believer that if somebody asks my opinion, especially when I'm out around public, I'll do it. So a lot of times people come up to me and they'll talk about the markets or whatever, but they never actually ask my opinion. Mm-hmm. So I never offer it unless they ask. Now, if they're a client, you pay for my opinion, you're going to get my opinion whether you ask or not, right? I mean, that's what I'm supposed to do. But individual is talking, it's like, hey man, the market's going to be great going into the year. Fed's getting ready to cut. I am so excited. I'm kind of piling in all that first cut. So this is a retail investor that's in the construction industry, does it as a hobby on the side, gets all excited about it, enjoys it. And I do enjoy having conversations. But then you turn around and you read something like the Mad King, who puts out his research report, and other professionals on the institutional side is like, hold the markets until the first Fed rate cut. So you've got this dichotomy taking place right now where you've got a retail investors that's so excited about this first Fed rate cut, and then you've got institutional professionals that this is what they've done for a living and they're seasoned at it, right? That are saying, hey, the time to sell is after the first Fed rate cut. And and the last time that the Fed cut rates, I think we talked about it last week, was September the 18th, 2007. And the market peaked within 30 days after that. And then we're down 57%, over the next a year and within the next year and a half, I think March 2009 was the bottom. The average stock bottomed in November of 2008, but the indexes didn't bottom until March of 2009. So that's what gave us an indication that March 2009 was the time that you wanted to start, getting a little bit more aggressive, because your average stock bottomed in November of 8, but the indexes bottomed in March of 09.
Interesting. Now, you had a Mad King chart we looked at before we got on here. Can that one with the divergences, I think that's sort of fits in the topic of what we're talking about here.
This is the one we were talking about here, right, Chris?
Yeah.
So basically what he had gone through was he said, look, the economy's slowing. We've got all kind of data that's showing that it is, but it hasn't mattered because payrolls have been strong. But in here, we've got government, U.S. total non-farm payrolls going back to 1994, and then you've got the Mad King payrolls composite. So I put in here this divergence, but why after 30 years of correlation do we all of a sudden have non-correlation that's occurred?
Huge non-correlation.
Yeah, I mean that's tremendous. Well, if we take the evidence of what's taken place, we're being told one thing, you're getting statistically all of these revisions to the numbers behind, and then truth is not honored or loved by the media or the politicians. And if they think that they're operating in integrity where they're just carrying their boundaries around them, right? There is no boundaries to them, then this is an indication that something has changed. And that adds, you add the smoke and the evidence that they're lying in so many other areas. Can we trust the data that's coming out of the government now? That's my biggest question. I do not. This is just another piece of evidence that tells us we cannot. That's a massive divergence. At least back in 1997, they're still headed in the same direction. One was a little bit higher than the other, but they both stalled at the same time. They've had this correlation, and then all of a sudden, this is just another piece of data that tells us that the economy is not as strong as what they're telling us it is.
What exactly is that red line?
The red line that's under the non-farm payrolls in black.
Mm-hmm. Yeah.
So that's the Mad King's U.S. payrolls composite. So that's something that he's put together as a composite to try to track the U.S. total non-farm payrolls.
Okay, that's interesting. So we all know that top black line, they've been lying about that, right? Because, lying is when you systematically overstate something and there's a system to it. That means it's lying, right? So we know that the BLS has been lying about this to the tune of 818,000 jobs over the past year. And they just had to even here in 2024, they had to downgrade the last 2 months. So they just say it's a big number and then they downgrade it. So that top line probably has to come down. Now, again, this would be awesome stuff in a debate format because, one of the things I hear from the Biden-Harris side is they're like, oh, we created 13 million jobs. They like to say that as if the president actually has anything to do with that, which they really don't. So They should just leave it aside. But even that aside, that red line says that actually we're about the same number of jobs, give or take a slight wiggle, as we were in 2019, right? So we've gone nowhere. You can't make a case for 13 million new jobs anywhere on that, right? Not a chance.
You cannot. And if I move it around, you're right. Very perceptive. That goes back to 2019. I was highlighting it basically stalling there, but you're right.
Yeah.
That just basically tells you the entire narrative has to be wrong. And the revisions are telling us that. And the thing that concerns me the most about that is if you look at what's taken place, all of the computer trading algorithms are built on the headline because you could trust the headline numbers. So by the time the revision comes along, those computers have not, at least at this point. Now, if I'm a hedge fund manager and an institutional investor at this point, I'm going to change my trading algorithm. I may trade the headline, but I'm also going to trade the revision. And, I don't know if they'll do that or not, but that's the problem. It's automated and they're taking advantage of that through their deception to try to make things look stronger than what they are. It's a plastic face. We don't love the reality.
It is. And so let's talk about it, because if things are weaker than advertised, of course, then the headlines aren't giving you the number. But this is from the Kobasi letter again, writing just a couple days ago, wrote, "This is insane. Quote, full-time employment dropped by 1 million workers in August on a year-over-year basis, marking the seventh consecutive monthly decline. Since the June 2023 peak, full-time job count in the U.S. has fallen by a whopping 1.5 million. Meanwhile, part-time employment rose by 1 million year-over-year in August. And additionally, the number of permanent job losers jumped by 324,000 year-over-year to 2.5 million, highest since November 2021. So this is the longest streak of part-time job gains since the 2008 financial crisis. This is the reality of the job market. Fewer full-time workers, more part-time workers. That is a sign of weakness, not strength, but they still all get counted in the non-farm payrolls as a part-time and a full-time counts as one each, right? So I disagree with that methodology. I think they ought to have different weightings, but that's okay. But then the real shocker, of course, has been, and I think this again, I won't read that out because we're probably on YouTube here. But this is coming from Geiger Capital saying, I thought this was a typo, but in just August, 635,000 immigrants, legal and illegal, gained a job. Meanwhile, 1.325 million native-born Americans lost their job. And here you can see in red, foreign-born, illegal and legal. This is what they've gained. This, you can tell who's getting the love in this story. And the blue is native born, and you can tell who's not getting the love in this story. And this needs to be talked about. What kind of an administration do you want? One that loves the red line, or maybe spends more attention on the blue line? Does it matter? Is it a difference? Should we be, caring about one versus the other? But you can clearly see, Paul, at least to my eye, that this has not been a colorblind society where everybody has an equal shot and we're just bringing in new people to give them a fair leg up. Somebody has officially been leaning on tilting this so that one group of people is doing much, much better than another group of people. And again, I think that's worthy of conversation. I think we ought to be saying, let me fractal it down. If in my town said, hey, Chris, your taxes are going to go up. And in fact, we need you to lose your job because we got these other people who we want to give free housing and a job to. So we need you to fund that. Obviously, you would go, I would say, how about no, right?
No.
Right.
How about no?
How about no? But this is what's actually been happening. And so, again, those algos can, make stocks go straight up, and that they're having their little fun time, and then the headlines will be written about how great this all is, and markets were cheered by. Stop. We need to start talking about the fundamentals in this story, which is a weakening economic environment, an out-of-control government spending program, and followed up by a Federal Reserve that just can't help itself. Whenever Wall Street gets a runny nose, it's there with a box of tissues, giving them, another bailout. And so that's been the system. And unfortunately, it's created a weaker, more uncertain future for our kids and grandkids and for the youth, for the young.
It has. It really has, and it's priced out. I mean, in every metric across the economy, trying to buy your median household, median home, right? Your starter home. Our citizens are priced out, and then you've got states that are fronting money up front for non-citizens. So it's like, the way I thought about it, it's like I tell my kids that they need to go to college, but when it comes time for them to go to college, I don't fund their college. I go fund somebody else's college, and they have to go borrow money to get there, right? So it doesn't make sense. Why would you not take care of your own as a family and then get that family strong and then reach out to be a blessing to others? Right? We want the right people to come into our country. We want good people to come here. We want them to come here because they want to participate in the American way. They're disciplined. They fight, for a better country and to pass what we've been able to inherit down to their children. We don't want to open it up and just give a blank checkbook to people who aren't going to appreciate it because they're not coming here for the opportunity to be rewarded for their struggles. Okay, some of them are. But when you wave this money out there, they're coming here to get something free. Okay, it's coming here so that I can have somebody take care of me, not so that I can come into a country that gives me the opportunity to be rewarded for my hard work. and we're hurting American citizens, our own family. We're taking away from them to give to others that don't necessarily appreciate that way of life. And it doesn't make sense. It makes sense if you're a globalist and you want the U.S. to fall and you want to have all nations equal and you want a one world government that's there, but it doesn't make sense if we're watching out for what's best for the American people.
Absolutely. And of course, again, it's just all gets confused. We can't have simple conversations. Look, we already had an immigration program. Immigration's a thing. Yeah. It's a big, complicated process. People apply. Somebody asks them a bunch of questions. We find out if they're a good fit. If they are, in they come, right? Migration ain't that process. That's just people just coming in from wherever, unvetted. Imagine, again, to bring it down, let's imagine you have 10 people working, you're a small manufacturing plant and you make stuff. And it involves, I don't know, CAD machines and lathes and, it's complicated. And the government comes in and says, hey, we got 10 random people. You gotta bring them in. You just 10 randos off the street now are your new workers. You're like, no, how about no, right? That's going to be a disaster. Well, if that's true there, it's true everywhere. Right? You would never bring in, like, as a landlord, you're going to go bankrupt pretty quick if you're just like, the first person who decided to cut me a check are my new renters. Yeah. That's not going to work out either. You might do a credit check, a background check, a criminal check, a reference check. There's some processes you would go through. Of course. Why is it any different at the national level? It's not. No. But that's the story we've been living in, and so I'm very worried about how this is gonna play out, because it's all sort of easy, Paul, to absorb people sorta when things are okay, but recessions happen, resources get tight, things don't always turn out the way you thought. The unit comes along, and next thing you know, the Federal Reserve is up against a wall, and now you watch the competition has to start up between native born, non-native born, as they say in the Federal Reserve's own, website. However you want to characterize that, I just think somebody has not been thinking this through from a dimension which the question was, how do we make this country and this world a better place?
Right.
I don't think that was the question.
It's what can we do for our own benefit or for our globalist agenda is what it seems like it will be.
Yep, which is a very abstract concept, and it's not grounded in reality, all of that. So, well, that's the time we have. And, of course, your portfolio really ought to be grounded in reality, and your conversations with your financial advisors ought to be grounded in reality. So I invite you, if you want to talk with Paul and his amazing team, please go to peakfinancialinvesting.com, fill out a very simple form. Somebody from Paul's team will be in touch with you within 48 business hours, if not sooner. And, Paul, how's it been going so far?
It's been going great. I had somebody today that made me feel so good, because it's like, look, I've had so many conversations and I've asked you things that I'm embarrassed to ask other people about, and you're not judging me. We're just having a conversation and how we plan for that, and my answer was like, we don't have to worry about that right now, but that's a great question. Here's how we'll deal with that. And here's the indication that we need to make that adaptation when that time comes. And it's just enjoyable. To me, that's what I've been doing for people for my whole career. And it's disappointing that there's not more of us in this industry doing that, right? Mm-hmm. It is disappointing. So I enjoy it. It's been going great. We're continuing to add people to the team so that we can help provide, the service that people deserve and help them navigate the days ahead.
And that's the most important part. I just, all the feedback I get, you work with people, not accounts, right? You deal with the people involved. And I love that. I love that about you and your team. So with that, look, people, we talked about some stuff. Some of it seems a little dark. There are things you can do. I believe that being paralyzed is not a good strategy at this stage. Like it or not, we're in the game. The game is going on. We're going to have to make moves. Not making a move is a move. So that's where we are, and you deserve to work with somebody who sees the world that way and can have an honest conversation about it all. With that, Paul, can't wait to see you soon. See you at the summit, I guess, tomorrow.
Tomorrow. So, I'll get to see you tomorrow, so looking forward to it.
Fantastic. in person. So with that, thanks everyone. We'll see you next week. And I hope you enjoyed this episode of Finance U with Chris Martenson and Paul Kiker.